Hello everyone. In this recording we are going to lecture on Chapter 2. Okay, now Chapter 2, I am going to start to talk to you about cost flow through an inventory system, which is one of the major points of cost accounting. We're going to talk a lot about manufacturing companies and flowing the inventory cost through the system, through the assembly line process. But before we get into an example of how costs flow through the assembly line process, first let's talk about basic terminology. So first, what does this word cost mean? Well, cost could be an actual expenditure where we're spending money on something, but it could also be a sacrifice. So some of you may have heard, some of these terms, opportunity costs. This term opportunity cost doesn't mean that cash was actually laid out for an expenditure. Opportunity cost basically means the benefit given up because we chose one alternative over another. So a cost could be a sacrifice, or it could be an actual foregone resource, meaning a cash outflow. An actual cost, meaning actual cash outflow. A budgeted cost is what we predict for the future. And a cost object, be familiar with this term, cost object. A cost object is anything for which a cost measurement is desired. Let me give you some examples. So if the product that we're making is the cost object, let's say a BMW vehicle, all right, obviously all of the costs going into manufacturing that BMW. If the cost object is a service that we're going to provide to our customers, an example would be a telephone hotline providing information and assistance to BMW dealers or possibly even BMW owners. If the actual project to make the BMWs is the cost object, right? The project is going to come along with R&D costs, research and development. If the customer is the cost object, what costs are assigned to the customer? Okay, well, let's take a dealer that purchases many BMW vehicles. Okay, they're the customer, right? We're a BMW plant. We are selling our vehicles to these dealers. Any activity, it could be any activity within the process. An example would be setting up machines for production of the vehicles. The cost object could be any department. It could be the accounting department, the HR department, the health and safety department. Okay, so a cost object is anything that we want to look specifically at the costs assigned to that particular object. Now, in this course, I will be honest with you, we are going to take a lot, especially when we're dealing with inventory, we're going to take a look at the cost object of being the product. We are going to manufacture a product and look at all the assembly line processes and all the costs along the way that are added to the product. Okay, as a production is going on, an assembly line process, we're manufacturing a product, we are going to accumulate costs over these different processes. The different costs, and I'm going to show you more about this in a minute, the different costs associated with the manufacturing process come in three major categories, and you should be extremely familiar with these three major categories. That would be number one, direct materials. Number two, direct labor. Number three, manufacturing overhead. All right, so we're going to accumulate all of these different types of costs. Materials, labor, overhead. Materials, labor, overhead. Materials, labor, overhead. I said that a few times for effect. So these materials, labor, and overhead, yes, we're going to accumulate them, but it really should not stop there. What we have to do is we have to take all of these accumulated materials, labor, and overhead costs and assign them to individual products. We could make a product, you're going to see in this class, we could make a product that is the same as to the other products we're making. Example, we are making bars of soap, and we're just cranking out the bars of soap on the assembly line. Well, these bars of soap are not unique. They are exactly the same. Let's say you use ivory soap, or whatever soap you use. The bars of soap for ivory, they are going to look exactly the same. And we're going to use a certain accounting methodology to assign the cost to the bars of soap. All right, that is called process costing. We're going to have a whole chapter on process costing. And then we might have inventory that we make, that we produce. Each one is very unique. Let me give you an example. Down here, Florida Atlantic University is in Southeast Florida. For those of you that actually live here in Southeast Florida, you know that there are a lot of communities, let's take residential communities, that are being built brand new homes. Well, the home builder is dividing their land into different lots, and each lot is going to be purchased by a new homeowner. And when the homeowner purchases a lot, they have to pay for the lot, number one, the land, and number two, once they pick their land and buy their land, they actually need to build their home. Well, the home builder is going to let the new homeowner pick their materials. You want a certain floor, you want a certain tile, you want a certain carpet, you want a certain wood floor, what color, kitchen cabinets, kitchen countertops, bathrooms, you name it. So my point is this. It's not like the bars of soap where every single one is the same. In this case, every single lot is going to be unique. And yes, we're still going to assign costs, but we're going to use what's called job costing. So we have a whole chapter on job costing. We have a whole chapter on process costing. All right. So let's take a look at some more terminology. So our costs, material, labor, and overhead, they are also going to be known as either direct costs or indirect costs. Direct costs, we can very confidently take every single penny of a particular direct cost and trace it directly to a cost object. Example, direct materials. Let's take the assembly line of motor vehicle. I know exactly which, or let's take the example of the home builder, a little easier. I know exactly which kitchen cabinet went to which lot. That is a direct material. How about direct labor? I know, because my workers are clocking in and out, which lots that they are working on for a particular day. Direct labor. All right, now let's take a look at overhead. Overhead's a little different, isn't it? Overhead is indirect. Example, property taxes. Property taxes on all of the land. Well, in the beginning, we don't know directly the property tax for each particular unit in the beginning when we're developing the land. Now when we start to break up the land into different lots, that's a different story. But in the beginning, when it's just one big piece of land and we're paying real estate taxes, that's an overhead item. And then we have our water, we have our electricity, we have our gasoline, we have our supervisor's salary. That's a perfect example. Right? Our supervisor is overseeing 12 different lots today. Well, that's an indirect cost, right? Yes, we can assign it to a particular unit. We're making a certain inventory item that we're making, but in a more indirect way. And what we need to do as cost accountants, we need to figure out a systematic, a very rational way to assign the indirect cost to each individual inventory item. And that's something that we're going to do in our job costing and our process costing. By the way, we also have another chapter called ABC, which is called activity-based costing. And ABC just digs down a little bit deeper in the systematic and rational cost assignment process. More on that in a few chapters from now. Okay, so once again, staying with the example of building the BMW, The direct costs would be direct materials and direct labor, as I talked about. The indirect cost would be more of the overhead. The lease for the plant, the manufacturing plant. The electricity in the manufacturing plant. The taxes for the manufacturing plant. So the direct costs, very easy. We can easily assign them to each individual BMW. And the indirect cost, we got to come up with a rational way to assign the cost to each individual BMW. And here's another example. Like I said, direct costs are materials and labor, the labor of the assembly line workers. The indirect costs are the overhead, electricity, rent, property taxes, administrative expenses of the plant, the janitorial expenses, the maintenance. All right. We will have to come up with a methodology to assign the overhead, the indirect cost, to each product that we are making. Okay. Now, all of these costs, direct costs, indirect costs, materials, labor, and overhead, they behave in one of three ways. Each cost could either be a variable cost, number one, could be a fixed cost, number two, or it could be a mixed cost. Mixed is partly variable, partly fixed. It's a mixture of the two. Okay, now what is a variable cost? A variable cost will change in total as activity changes, meaning as activity increases, our total variable cost will increase. As activity decreases, our total variable costs will decrease. But the variable cost per unit remains the same. Let me give you an example. Let me say that we, old school cell phone plan, where we pay by the minute, okay, of being on the phone. Say it's 10 cents a minute. Okay, 10 cents a minute. That is a variable cost. As we talk more on the phone, the total variable cost will increase, but the variable cost per minute stays the same, 10 cents. Okay, now let's talk about a fixed cost. A fixed cost in total remains the same regardless of activity. So let me say, let me give you the example. Once again, let's deal with the cell phone. Most of us have a fixed cell phone plan now. We pay $40 a month, regardless of activity. We can talk on the phone for 1,000 minutes. Some of you can talk on the phone for more than that. Some of you can talk on the phone for 2 minutes a month. You're paying the same amount. That is a fixed cost in total. But let's deal about the fixed cost per unit. Think about this. As activity increases, your fixed cost per unit decreases. See, it's an inverse effect. So let's say I spend 1,000 minutes a month on the phone. My fixed cost per minute is going to decrease, as opposed to someone that spends 2 minutes on the phone for the month. You're paying the same price, but your fixed cost per minute is going to go drastically up. So be careful with that. A mixed cost is partly fixed and partly variable. There are a couple of methods to estimate mixed cost into breaking that out between the variable piece and the fixed cost, the fixed piece. More on that in a little bit. Okay, this slide is awesome. This slide summarizes what I've been trying to say to you. The variable cost in total will increase as activity increases. It will decrease as activity decreases. But the cost per unit will always remain the same, regardless of activity. Fixed cost is the opposite. The fixed cost will remain the same in total, regardless of activity. But it changes inversely with activity. More activity, lower cost per unit, and vice versa. Here's a graphical explanation of what I've been saying. So let's say the BMW that we are assembling, steering wheels. And you can see the graph. On the y-axis is the total cost of the steering wheels. On the x-axis is the number of BMWs that we're making. And as you can see on the graph, as we make more BMWs, the total cost is going to go up. But the cost per steering wheel remains the same. That is an example of a variable cost. Now look at the graph to the right. This is panel B. This is an example of a fixed cost. And what are we talking about? What are we talking about? We're talking about the supervision costs. So the supervisor on the assembly line floor, they're not working on the actual product, but they have a fixed salary, whatever it is for the year, $50,000 a year, whatever. It doesn't matter how many BMWs are made, which we can see from the x-axis. But the y-axis is the total supervision costs in millions. These numbers are in millions of dollars. So you can see it does not matter. The activity level can be 0. It could be 60,000, but the cost remains the same. That is an example of a fixed cost. So hopefully by now, between these 3 or 4 slides and me trying to explain cost behaviors, you got a general sense of variable costs, how they behave, and fixed costs. And like I said, a mixed cost will have both variable and fixed elements, and we'll talk more about how to break up our mixed cost into those two fixed and variable elements at a later time. Okay, a cost driver. Basically, a cost driver is what affects costs to change over a given time span. What drives the cost to change? That's something you need to know. Another thing you need to know is relevant range. So all of these concepts I am talking about is true. So the fixed costs and the variable costs and how they behave, it is true within a range of normal activity. As an example, rent on the assembly or taxes on the assembly line plant. That could be a fixed cost. It could be the same. Taxes, rent, regardless of if we make 0 BMWs or 1,000 BMWs in the month. It doesn't matter. The cost is going to remain the same. That's a fixed cost. Within the relevant range, that is true. Let me give you this example. Let's say we now have to make 5,000 BMWs a month. But the assembly line plant won't accompany that because the capacity is too low within that plant. Now what do we need to do? We need to buy another plant or rent another plant. What have we done? We've gone into another relevant range. All right, we've expanded. So the rent is now double. The taxes have gone up. So relevant range within the normal range of activity. Okay, so how can we classify these costs? Like I said, costs are the 3 major buckets of costs for the manufacturing. The inventoriable costs, if you will, are materials, labor, and overhead. They could be classified, just to sum up what we've talked about in the prior slides, as either direct or indirect, also as variable, fixed, or mixed. And based on these classifications, you can see, wow, we can have multiple classifications. It could be a direct and a variable cost, or it could be a direct and a fixed cost. It could be indirect and variable and indirect and fixed. And so on this slide, you can see some examples of costs that are direct and variable, like the tires used on the automobile. They're a direct material for each, and they're variable. The indirect and variable would be like the electricity for the manufacturing plant. Electricity is going to change based on our usage. For those of you that live here in South Florida, you know electricity, which runs our air conditioning, is extremely important. If we have a lot of people in the home, if the home is bigger, usually the electricity cost will have to increase with the activity going on within the home. So it's indirect, right? We can't trace every kilowatt of electricity used to each BMW, so it is indirect in that respect. It's an overhead item, but it's variable. Now how about direct and fixed? An example of that would be the salary of the supervisor. The assembly line supervisor, it is a direct cost, right? We know that the supervisor's salary could be directly assigned. Right? It's a cost that we know. Okay, they were working on these vehicles today, and it's fixed. He doesn't make overtime. He has a set salary. An indirect fixed cost would be like the rent on the assembly line plant. That rent needs to be assigned to each vehicle, so it's indirect in that respect. But it's fixed. It's the same amount every month. So you can see that there are various categories. Okay. And we need to be very, very careful when we're doing this because obviously different methodologies, we can come up with different cost assignments for our inventory. Okay, next subject matter before we get into a little bit of number crunching. In this course, when we talk about manufacturers, we're going to have 3 categories of inventory accounts. Now, you guys hopefully remember from financial accounting class, there is one asset inventory. You know, one inventory account that's an asset. And we call that inventory, merchandise inventory. But with manufacturing companies, we have 3 asset accounts. One is called direct materials. One is called work in process or work in progress, also known as WIP, W-I-P. You may have heard that before. And then, of course, we have finished goods. So let's think about the assembly line process where we're making the BMW. First, we buy a whole bunch of direct materials or raw materials. We've got steering wheels, we've got radios, we've got engines, we have bumpers, we have tires, we have seats, we have leather, we have, you name it. We've got metal. Those are the various direct materials. In and of themselves, it's really just a pile of junk. But what happens is we start production. And so we're going to grab some of these direct materials, these raw materials, and we're going to plop them on the assembly line. Once the direct materials get requisitioned into the assembly line process, that direct material cost is now going to be journal entried out of the direct materials into the next inventory account, and that is called WIP. And also in the WIP process, we are going to add our labor and all of our overhead. And then ultimately, when the BMW makes it to the end of the assembly line, we are going to take all of those costs out of the WIP and into the last inventory account called finished goods. And then from there, you should understand from financial accounting, we're going to sell our finished goods and it becomes, we will reduce the finished goods inventory account and we will increase our cost of goods sold from the income statement. Okay, now let me show you. Let me see. Okay, just some more vocab here so you understand it. The materials, the labor, and the overhead that I keep talking about, they are called either manufacturing costs or inventoriable costs. And once again, this is important because these manufacturing or inventoriable costs, they are interesting and unique because they have to flow through the 3 inventory accounts. Well, some of them 3, some of them only 2. Direct materials, work in process, and finished goods before they make it to the income statement in the form of cost of goods sold. Compared to period costs, now period costs do not take a break and flow through the balance sheet. They do not flow through an inventory account. The period costs go directly, right? It's a beeline directly to the income statement. Example, the accounting manager for the corporate office. Well, the accounting manager's salary for the corporate office, they have nothing to do with the assembly line. So that is an administrative expense. How about the CEO's salary? Another example, how about the electricity for the main administrative offices? These are examples of costs that will not flow through the inventory system. They will go directly to the income statement as general and administrative expenses. So you have to be careful. Not all costs are going to be inventoriable. And in your financial accounting class, you learned a term called cost of goods sold, right? And that's basically a fancy way of saying the inventory expense. Once you sell your finished good, you take it off of the balance sheet with a credit, and you debit the account called cost of goods sold. I'm not here to reteach you financial accounting, but just to remind you of that concept. Well, in this class, not only do we have cost of goods sold when we sell our finished goods, yes, we still have that. Yes, it's still going to be reported on our income statement, but there's another term that we need to understand, and that is called cost of goods manufactured. And basically, I'm going to show you this in a few minutes with some numbers. The cost of goods manufactured is showing all of the costs that made it through the direct materials and WIP accounts and made it to the finished goods account. It's basically the cost of goods manufactured is the addition to the finished goods account for the year. All right, now some numbers. And I know the slide is a little small. Hopefully you can read these numbers. And like I said, the whole process is direct materials, direct labor, overhead. Once again, direct materials, direct labor, overhead. Direct materials, direct labor, overhead. So let's follow this slide here. So I'm going to watch my cursor up here. I'm circling it so you can see. We have 3 inventory accounts. Direct materials, which is in blue. Work in process, which is in green. We have our finished goods, which is more of a brownish color. And then, of course, when we sell our finished goods, we come over to the income statement, cost of goods sold. All right. So we have the balance sheet over here with 3 processes. I'm going to walk you through that. And, of course, the income statement is over here. So we are going to start with our first of 3 inventory accounts, and that is called direct materials. Now, we started the year with $11,000 in direct materials. We know that because our ending balance from the prior year in our direct material inventory account was $11,000. During the year, I purchased $73,000 more direct materials. And at the end of the year, I counted the inventory on the shelf, the direct materials. There was 8,000. So beginning inventory of 11 plus purchases of 73, that gives you 84,000. 84,000 minus the ending inventory of 8. So 84 minus 8, that's 76,000. That means 76,000 of direct materials were used. That means $76,000 of direct materials were moved out of the direct material inventory account into the WIP. Now the WIP account, the beginning WIP balance, which is the ending balance of the prior year, was 6,000. Now WIP, what are we going to do? How are we going to add WIP? Well, 6,000, we're going to add our direct materials, which we just calculated at 76. And what else are we adding during the WIP process? We are adding labor and overhead. Once again, beginning inventory of 6, plus materials of 76, plus labor of 9, plus overhead of 20, minus ending inventory of 7. So if we do the math, 6 plus 76 plus 9 plus 20 minus 7, which is the ending inventory, that gives us $104,000. And what is that? That $104,000 are the materials, labor, and overhead that are moving out of the WIP into the last stage, which is the finished goods inventory. That $104,000, as I explained earlier, is called cost of goods manufactured. It's basically the materials, labor, and overhead that are finished. They're moving over to the last inventory account, balance sheet account. And once again, we're going to do the same concept. Beginning finished goods inventory was $22,000 plus $104,000 was added to the finished goods minus the ending of 18. that gives us our cost of goods sold, what we actually sold, which is $108,000. We'll subtract the $108,000 from our revenues of $210. $210 minus $108 gives us our gross margin or our gross profit of $102. $102 less our period costs or our selling general administrative costs of $70. Subtract from $102, you get net income of $32,000. This is an excellent slide. This is something that you really need to have a good grasp on, because this is going to be the backbone to what we learn in the next few chapters when we talked about cost accumulation and cost assignment. Here it is. All the numbers that I showed you on the prior slide are basically here. We're going to see our revenues and our cost of goods sold. You should remember this formula from your financial accounting class. Beginning inventory plus purchases, in this case, cost of goods manufactured. You can go back to the prior slide. You'll remember it's 104. That equals cost of goods available for sale. Less ending inventory gives you cost of goods sold. Subtract that from revenues, you get gross margin or gross profit. Subtract out your selling general administrative expenses, and you get your operating income. Now, here is another schedule that I want you to know. And once again, you can link this schedule to what I just showed you 2 slides ago on flowing through the costs through the 3 inventory accounts. We have our direct materials. Beginning plus purchases equals available for use, minus ending equals direct materials used, plus labor, plus overhead. Add the 3 inventoriable costs, materials, labor, and overhead. That gives you manufacturing cost incurred, new for the year, plus beginning WIP. That equals total manufacturing cost to account for, less what's in the ending WIP, gives you cost of goods manufactured. And that $104,000, let me go back, is what gets added to the finished goods inventory. So please make sure you remember your cost of goods sold calculation from your prior accounting classes, and make sure you understand the cost of goods manufactured, which is the new concept in cost accounting with our 3 different types of inventory accounts: direct materials, direct labor, and manufacturing overhead. Okay. A little bit more vocabulary before we wrap this up. A prime cost. A prime cost is all the direct costs, basically the direct materials and the direct labor. A conversion cost. Okay. A conversion cost, and this is a typo here, it says conversation. Conversion cost basically are the labor and overhead. It's basically a way to convert the direct materials into a finished good. We can't convert our direct materials into a finished good unless we add labor and overhead. That is the way to convert. Overtime labor is typically considered indirect overhead, and you might hear this term idle time. Idle time is basically when our assembly line workers are sitting around and they're twiddling their thumbs. There's not much to be done. It's an unproductive time, maybe because there are no customer orders, maybe the system is broken down, some sort of work delay, whatever. Idle time refers to wages paid for all this unproductive time. So a lot of organizations, they may want to categorize idle time separately because it's one of those unique situations that hopefully doesn't happen all of the time. And that would make sense. Of course, when we are accumulating costs, but not only accumulating costs, but really assigning costs, it requires a lot of judgment. You're going to see that there are a lot of alternative ways for assigning costs. Judgment is certainly required. This is not something that is black and white in every single situation. You're going to see that a lot when we get to the ABC, the activity-based costing chapter. Okay? And different product costs for different purposes. We're going to see our product mix. Sometimes we have multiple products going through the assembly line, and we have to analyze and assign costs using our different product mixes. We can come up with different ways to do so. So be very careful with that. The following three features of cost accounting and cost management can be used for a wide range of applications. So number one, calculating the cost of products, services, and cost objects, obtaining information for planning and control, and of course for evaluation, and analyzing the relevant information for making decisions. So you can see not only accumulating but assigning costs. There's a big framework for why we would do that. Okay, so that is very, very important to understand our cost behaviors, our cost areas that we want to segregate into, and understanding how costs flow through the assembly line process.